to discuss the derivative instrument. Derivative is a financial instrument investment in which the gain and the loss is derived from other economic event for an underlying assets like the price of stock or the price of the currency and the change in the exchange rate or the increase or decrease of the price of a certain commodity. To enter in a derivative transaction, there is two parties. The first party is the buyer, sometimes called the holder, enter into the transaction to hedge and to avoid his risk. The other party is the seller, or sometimes called the writer. It enters into the transaction to speculate or to incur and hold the risk. Now, to know what it means, let us check this video.
I know what you are all thinking. What? What does that even mean? So I'm going to tell you the story of my friend Ramu, the farmer, to help you understand derivatives better. My friend Ramu is a farmer who raises cattle. He has 10 cows and wants to sell them in the market 1 year from now. He knows he will spend 30 rupees per cow to raise them. So his total investment will be 300 rupees. But now he's worried that if another spell of mad cow disease breaks out, he won't get much money for his cattle when he decides to sell them. So, to protect his business, Ramu meets an investor's broker and enters a business contract with him. You are the investor who has sent your broker to Ramu. You may think that mad cow disease is not likely to occur. So you tell your broker to agree to pay Ramu 100 rupees per cow 1 year from now, irrespective of the market price. What you've just done is entered a futures contract. Basically, futures are contracts that obligate the buyer to buy an asset and the seller to sell the asset at a predetermined future date and price. In this case, the futures contract obligates Ramu to sell his 10 cows to you at 100 rupees per cow 1 year from now and obligates you to buy them then at that price. Ramu agrees to this because this means that 1 year from now, whatever the market price is, he will get a profit of 100 rupees minus 30 rupees, that is 70 rupees per cow. He has limited his risk and locked in his profit. Ramu is playing it safe and it works out well for him. But what about you? If you're right and mad cow disease does not break out, let's see what position you'll be in 1 year from now. 1 year from now, the price of cows in the open market may even soar to 200 rupees per cow. This means that you will buy his cows for 100 rupees per cow and sell them in the open market for 200 rupees, making a profit of 100 rupees per cow or 1000 rupees on an investment of 1000 rupees. Wow! This is all pretty clear sailing so far, right? Right. But hang on a second. But what if you are wrong and there is a spell of mad cow disease? In this situation, the market price could drop to even 20 rupees a cow. Uh-oh. This spells trouble for you. This means you will have to pay 100 rupees for each cow and be able to sell them for only 20 rupees per cow, which means you will make a loss of 80 rupees per cow or 800 rupees on an investment of 1000 rupees. Yes, that's a huge risk to take. So is there a way that as an investor, you can limit your risk? Luckily for you, yes, there is. If as an investor, you do not want to take the risk of losing too much money, you could simply have an agreement with your broker called stop loss. This means that as soon as it becomes clear that your loss will go beyond a certain level, he will exit the futures contract and stop your losses from getting worse. Now, what does that really mean? It means that if, as an investor, you instruct your broker to stop your losses at 50 rupees per cow, the minute the market price reaches 50, he will exit the contract by selling it to someone else and stop your losses at 50 rupees per cow. So now you have limited your risk.
So for now, there's four main types for derivatives. The first type is option. What is an option? It is a contract that gives the right to buy, sometimes we call it call, or sell, that means to put a security or other financial asset, we call it the underlying assets. The second type is a forward contract, a customized contract between two parties to buy or sell underlying asset at a specific price at a specified future date. What is the futures? They are like the forward contract but are more standardized and regulated. And the last type is swaps. It is the exchange of one security for another based on different factors. Let's see what is an option. The buyer of an option buys the right to demand the seller of the option to buy or sell the underlying assets, the cow in our previous example, on or before a specified future date. The buyer always holds all the right. The buyer pays a fee to get that rights. What about the seller? The seller of an option, or we sometimes call it the writer, have to buy or sell the underlying assets, the cows in our example, on or before a specified future date due to the option's buyer demand. It means that he must have the obligations. The seller has all of the obligation, and the seller get a fee to hold this obligation. The options have two kinds of rights. Number one is a call option, and number two is a put option. A call option, the right gives the buyer, we call it the holder, the right to purchase and call for the underlying assets at a fixed time. That means a call option is a buying right, the right to purchase. What is the put option? The put option gives the buyer, we call it the holder, the right to sell the right and to put on to the market. That means the right to sell the underlying asset at a fixed price. Now let's have some important notes. The asset that is subject to being bought or sold under the terms of the option is referred to as the underlying assets. The party buying an option is referred to as the holder. The seller is referred to as the writer. The exercise of an option is always at the discretion of the buyer, the option holder, who has in effect both the right to exercise the option or not. That means that he has the right to put an option or not. The seller, the writer, of an option has no choice. He must perform its obligation if the holder chooses to exercise. An option has an expiration date, after which it can no longer be exercised. Now, some important notes also and terms in the contract of derivatives. The exercise price, or sometimes we call it the strike price, is the price at which the holder can purchase in a call option or sell in a put option the underlying assets. The intrinsic value is the value of the option today if it exercised today in the market. The intrinsic value of a call option is the amount by which the exercise price is less than the current price of the underlying asset in the market. As we notice, a call option means that you have to get price less than the current price because you are buying. In the put option, the intrinsic value of a put option is the amount by which the exercise price is greater than the current price of the underlying asset in the market because you are going to sell. Now let's have an example. An investor holds calls and put options for 200 shares of Ramos Company with an exercise price of US 48 per share, $48 per share. In case of call option, the right to purchase, we have to remember that the intrinsic value of the call option is when the amount by which the exercise price is less than the current price of the underlying asset in the market. That means that I have to find the price in the market is less than the current price in the market. Now, when Ramos company stock is currently trading, the stock of Ramos is trading at US $50 per share in the market. The investor option have an intrinsic value of US dollar to US dollar for each stock. So the option has a positive intrinsic value. This means that the option is in the money. But if Ramos company stock is trading at US 45 per share in the market, the investor option have an intrinsic value of 0 US dollar because the option has a negative value. So this means the option is out of money. Now we will continue the same example, but in the case of a put option or the right to sell. Now I want to sell. So we have to remember that the intrinsic value of a put option is the amount by which the exercise price is greater than the current price of the underlying asset in the market. When Ramos company stock is currently trading at US $50 per share in the market, the investor option have an intrinsic value of 0 US dollar. That's because it is negative value, negative amount. So this means the option is out of the money. But if Ramos company stock is trading at US $45 per share in the market, the investor option have an intrinsic value of US $3 for each stock. So the option has a positive intrinsic value. This means that the option is in the market. Now, thanks for watching. Hope you enjoyed the video and get some benefits. For any question or inquiry, please leave your comment and I will answer you. Let me know if you need special topic to handle for you in the next video. Just write in the comment. Please don't forget to share and subscribe. Need your support to take on more subjects. So subscribe now and don't forget please for your support. Thanks.